So good afternoon. Welcome to the September 2019 quarterly superannuation update. My name is Mailene Wheeler and I am the Associate Director at the Superannuation Advisory Team at Vincent's. There are my contact details if you need to reach out to me. All right, so as part of the September 2019 quarterly superannuation update, we're going to look at the upcoming important superannuation tax dates, an update on the status of superannuation legislation since our last webinar, the ATO website updates that specifically relate to superannuation. We're also going to have a look at some recent super announcements in the news, and then we're finally going to cover off on the recent changes to the definition of non-arm's length income. Okay, upcoming dates. So here are some important super dates. Please note this table does not include the lodgement deadlines that relate to your quarterly or monthly activity statements and payment of PAYG instalments. So on the 28th of October 2019, this is the due date for payment of super guarantee. That's your 9.5% mandatory super for the September quarter by employers to funds. It's also the date that your T-bar is due if you have any transfer balance account events that occurred during the September 2019 quarter and you were required to report quarterly. 31 October 2019, this is the date where you have to lodge and pay for your 2019 SMSF annual returns if you've got more than one or if you've got an outstanding prior year tax return. However, if you do get up to date and lodge your prior year outstanding tax returns by 31 October, your 2019 tax return will then be due under the date it would be under the normal lodgement program. Also, if you're a newly registered super fund and have been given this date, this is also the date that you'll be required to lodge and pay for your tax. And it's also the due date for any T-bars due to any T-bar events that occurred during the 18-19 financial year and you're an SMSF that has a tax return due on this date. Okay. We also have some other dates in here that take us through to December about your large to medium taxpayers. Their tax payments are going to be due on the 1st of December, while their tax returns won't be due until the 15th of January. The 15th of January is the date that those medium to large taxpayer self-managed super fund tax returns are due. And then the 28th of January is the due date for our December 2019 quarterly super. All right, let's have a look now at some legislation updates. So new law. Since our last super update, the following superannuation related bills have passed both houses of Parliament and have received royal assent and are now law. So the Treasury Laws Amendment 2018 Superannuation Measures Bill number 1, Measures number 1 Bill 2019, was a bit of a mouthful, includes 2 previously announced integrity measures with an effective date of 1 July 2018. So this legislation expands the definition of non-arm's length income, or NALI, which we will discuss in further detail a bit later in this webinar, and it requires the calculation of an individual's total super balance to include, in certain circumstances, the outstanding limited recourse borrowing arrangement amount that is attributable to each member where the fund has entered into a limited recourse borrowing arrangement where the contract was made on or after 1 July 2018. The other bill that passed and is now law was the Treasury, can't get that word out today, people, Treasury Laws Amendment Putting Members' Interest First Bill 2019. This covered the provision of insurance on an opt-in basis for account balances of less than $6,000 and for members under 25 years old from 1 April 2020. The law also contains an exception for the opt-in regime for members in dangerous occupations. Oops. Bills before Parliament. So the following superannuation related bills are awaiting progress in the House of Representatives. The following bill. So the Treasury Laws Amendment Recovering Unpaid Superannuation Bill 2019. On the 24th of May 2018, the government first introduced a 12-month superannuation guarantee amnesty. The relevant bill failed to pass the Senate and then lapsed when the federal election was called on the 11th of April 2019. On the 18th of September 2019, the bill was reintroduced with an amnesty period beginning on the 24th of May 2018, which will end 6 months after the legislation receives royal assent. So under existing law, if you've missed a payment or haven't paid an employee's super on time, you are required to lodge a super guarantee charge statement and pay the super guarantee charge on any SG shortfall amounts. The SG charge includes a liability for the mandatory administration component of $20 per employee per quarter for the SG charge statements lodged. To use the amnesty, employers must still pay all the super that is owing to their employees, including interest. However, the amnesty will encourage employers to come forward and pay outstanding superannuation by not hitting them with the penalties that would usually be associated with late payment. To qualify for the amnesty, the disclosure must be made before the end of the amnesty period, which, as I mentioned, is 6 months from the date of royal assent. So this bill is currently only at the House of Representatives. It must contain information that has not previously been disclosed to the ATO. It must be made in the approved form, which will generally include the super guarantee charge statement. It must relate to the March 2018 and earlier quarters. So the quarters that are currently within this amnesty period are not eligible for amnesty. It also must be made before the ATO advises of any review or audit of super guarantee charge obligations, which are commonly referred to as an employer's obligations audit. Now, the media release issued by the Assistant Minister for Superannuation, Financial Services and Financial Technology, Jane Hume, stated that since the one-off amnesty was announced, over 7,000 employers have come forward to voluntarily disclose historical unpaid super. The ATO estimates that an additional 7,000 employers will come forward due to the extension of the amnesty. This means that there's around $160 million of superannuation that will be paid to employees who would have otherwise missed out. This is great to hear. All right, so let's have a little look at the ATO website in the recent months, what they've updated in relation to super and self-managed super funds. So the ATO has updated their page on the ATO We're Here to Help. So the ATO are reminding SMSFs that as the regulator of the self-managed super funds, who coincidentally they're celebrating their 20th year anniversary of that this year, the ATO's primary focus is to support, inform and assist trustees and their advisors by providing a range of guidance, resources, tools and services that make managing the regulatory and tax aspects of an SMSF as easy as possible. These ATO resources are free and they're available at the SMSF resources section of their website. The link is included in the slides there. And they include videos, case studies, questions and answers, technical resources, speeches, presentations, webinars. They've got checklists, which include the new approved SMSF auditor checklist. There's an SMSF regulators bulletin, and there's also some valuation guidelines for self-managed super funds. Another update. So the 7th to the 13th of October is Stay Smart Online Week. So the ATO are encouraging people to use this week to check that they are staying and that their members of their super funds are staying safe online. So there's more information available at that link. The ATO also updated some information on how long it takes them to process a new SMSF application. So it can take up to 28 days for the ATO to review new self-managed super fund applications. During this review period, the SMSF status will initially be displayed on the Superfund Lookup website as election to be regulated is being processed. They'll then update the status of the application for any applications that give the ATO no concern to registered. Once they've got this status, SMSFs will then be able to accept contributions and rollovers. New SMSFs should therefore factor in about a 28-day time frame when they're doing financial planning. Within a week of the SMSF status changing to registered, a formal notice of compliance will be issued and the status will be changed to complying. It's worth noting that if the ATO needs to investigate the new SMSF application further, the status will change to regulation details withheld. And most of these cases are generally resolved in under 2 months. It can take longer if extensive investigation is needed. If the ATO's investigations result in an SMSF application not being allowed to proceed, its registration will be cancelled. The ATO has also updated their section on non-arm's length income after the passing of the law to expand the definition of NALI. So they, quick update, which I'm going to go into in a bit further, is that SMSFs are required to invest on a commercial arm's length basis that reflects the true market value of assets. Any non-arm's length income is taxed at a highest marginal rate. The ATO has updated to give some more examples and information on this. So what's happening? Super news. So some more changes to the super fund lookup status. So from 1 October 2019, if the lodgement of a self-managed super fund's tax return is more than 2 weeks overdue, the status of the SMSF will change on the super fund lookup website. This means that, the new status, regulation details removed, will remain in place until the overdue lodgements are up to date. Now, the ATO has stated that they are taking this approach to protect retirement savings. On the first business day of each month, they will then update the Superfund Lookup website and change the SMSF details to regulation details removed when an SMSF has an annual return more than 2 weeks overdue, and complying when the SMSF lodges the returns during the previous month. So what does this actually mean? So while a SMSF status is regulation details removed, employers will not be able to make any super guarantee contributions into that self-managed super fund for its members. If they are using an electronic a clearinghouse, the payment will be rejected. So SMSF members will need to tell their employer to make their super guarantee payments into the employer's default super fund or into another fund of the member's choice. Also, APRA funds will not roll over any member benefits to the SMSF. However, once the super fund lookup status is reinstated to complying, members can then request for their external balances to be rolled inside to the self-managed super fund. So it's really important to note that trustees can avoid their self-managed super fund status changing to regulation details removed by being proactive. When you know a lodgement is going to be late of your tax return, the SMSF trustee or their tax agent should seek a deferral to lodge the tax return and you're asking for an extension. This will ensure that the self-managed super fund status remains complying. You've got to note still then that if you don't make your extension lodgement deadline, that again, it's going to be changed to regulation details removed and contributions and rollovers cannot occur within the super fund. And this status will remain until all the outstanding lodgements have been brought up to date. In further super news, the Treasurer has announced a review of the retirement income system. So the Treasurer, Josh Frydenberg, announced on the 27th of September that the government has commissioned an independent review of Australia's retirement income system. The review will look at the 3 pillars of the existing retirement income system, which are comprised of the age pension, compulsory superannuation, and voluntary savings. The review will cover the current state of the system and how it will perform in the future as Australians live longer and the population ages. A consultation paper will then be released in November 2019 and the final report provided to the government in June 2020. Oops. Went one too far. So the review is going to establish a fact base of the current retirement income system that will improve understanding of its operations and the outcomes in its delivering for Australians. The retirement income review will identify how the retirement income system supports Australians in retirement, the role of each pillar in supporting Australians through retirement, the distributional impacts that happen across the population and over time, as well as the impact of current policy settings on public finances. All right, so let's look at our little special subject. So as previously mentioned, the Treasury, I cannot get that word out today. The Treasury Laws Amendment 2018 Superannuation Measures No. 1 Bill 2019 was recently enacted, which impacts how some self-managed super funds report non-arm's length income from the 2018-19 year onwards. On the 2nd of October, the ATO released a draft Practical Compliance Guideline, PCG 2019-D6, for consultation on the proposed compliance approach, as well as a draft Law Companion Ruling, LCR 2019-D3, on non-arm's length income expenditure incurred under a non-arm's length arrangement. Okay, so let's get a little technical here. So Section 295-550 of the Income Tax Assessment Act sets out the rules as to when a complying super fund will derive non-arm's length income. So the proposed amendments to Section 29550 have resulted in a complying superannuation fund deriving NALI in circumstances where the entity incurs non-arm's length expenditure as described in paragraphs 9 to 12 of the LCR. So the amendments apply in relation to income derived in the 2018-19 income and later years, regardless of whether the scheme was entered in before 1 July 2018. So what is this? The intent of the NALI provisions is basically to prevent income from being converted into superannuation entities as a means of sheltering that income from normal rates of tax applying to other entities, because we've got a concessional tax environment in our self-managed super funds. We're paying tax from 0 to 15%, especially when you compare that to the higher rates that you can pay as an individual, which can go up to 49%, including your Medicare levy. So, an overview of the amendments of the NALI provisions. So the taxable income of a super fund is made up of two components. You have this low tax component, which is taxed at 15%, and then you have this other component, which is taxed at the top marginal rate, which is your non-arm's length component. The non-arm's length component for an income year is the amount that a super fund's non-arm's length income, less any deductions to the extent that they relate to that income. So where you have income, either ordinary or statutory income, and it's treated as NALI, it's not exempt current pension income, which means that it's not tax-free, it's not there to support a pension. So the relevant NALI existing provisions apply where a super fund derives ordinary and statutory income under a scheme where basically your parties aren't dealing at arm's length in relation to a scheme, and the amount of income is more than what might have been expected had it been derived between two parties dealing with each other at an arm's length basis. It also can occur where it's derived income as a beneficiary of a trust through a fixed entitlement to the income of the trust, where the fund acquired the entitlement under a scheme, or the income was derived under a scheme that the parties to which were not dealing with each other at arm's length, and that the amount of the income is more than what might have been expected to have been derived if those parties had been dealing with each other at arm's length. So while retaining the existing rules, the proposed amendments remove any ambiguity and I cannot speak today, sorry people, in the application of the NALI provisions by clarifying their application where a complying superannuation fund incurs a loss, an outgoing or an expenditure, or does not incur a loss, outgoing or expenditure in certain circumstances. So again, that's just talking about what I've said before about there's a scheme where two parties aren't dealing with each other at arm's length and you're incurring a loss, an outgoing or an expenditure, and that outgoing or expenditure is less than the actual amount that the fund might have been expected to incur had those parties been dealing with each other at arm's length in relation to the scheme. The income is also NALI if the fund does not incur a loss, outgoing or expenditure, and the fund might have been expected to incur those if the parties had been dealing with each other at arm's length. So the ATO has provided some clarification on particular issues in the LCR 2019 D3. So one of these issues is concerned with when non-arm's length expenditure will have a sufficient nexus with income derived by the super fund for the NALI provisions to apply. So in particular, the Commissioner has set out a preliminary view that certain non-arm's length expenditure, which is incurred by a super fund, may have a sufficient nexus to all of the ordinary and statutory income earned by the super fund. Therefore, that income will be treated as non-arm's length income. An example that they have given is accounting fees. So this is contrasted to non-arm's length expenditure that has a more direct nexus to a particular ordinary or statutory income derived by the fund. So, for example, if you've incurred some expenses in relation to acquiring an income-producing asset. So to explain it a little bit better, let's look at the ATO example. So the ATO uses the following example to demonstrate how the NALI provisions can apply to all the income of a super fund as a result of a non-arm's length arrangement. So this is taken directly from the ATO. For the 2020-21 income year, Macarthur, as trustee of her self-managed super fund, engages an accounting firm where she is the partner to provide accounting services for the fund. The accounting firm does not charge the fund for those services. For the purposes of the subsection 295-550-1, the scheme involves that the self-managed super fund is acquiring the accounting services under a non-arm's length arrangement. The non-arm's length expenditure, this is the nil amount incurred for the accounting fees, has a sufficient nexus with all of the ordinary and statutory income derived by the self-managed super fund for the 2021 year. So under these provisions, all of the super fund's income for the 2021 year is non-arm's length income and is subject to tax at the highest marginal rate. My next slide kind of sums up our feelings towards this. So paragraph 16 of the LCR 2019 D3 specifically states that in identifying whether the complying superannuation fund has incurred non-arm's length income, there must be a sufficient nexus between the non-arm's length expenditure and the relevant ordinary or statutory income. That is, the expenditure must have been incurred in gaining or producing the relevant income or acquiring the relevant entitlement. My question: how then are accounting fees, which relate to the recording of historical investments and fund admin expenses and the calculation of tax, and how is that deemed to be an expense that is incurred in gaining or producing income? I don't see how accounting the accounting fees services qualify as that. But following the guidance in the PCG 2019 D6, the ATO is going to have a transitional compliance approach, which will allow funds to transition to an arm's length arrangement to ensure compliance by the 2021 year. So failure to comply by this time will result in all of your funds' income be treated as gnarly and taxed at the highest marginal rate. So while they've used the accounting fees, there are many other examples that can apply where a trustee is providing a service at no cost to the super fund. So that's why we now have to look at in what capacity are these activities being provided for the super fund. So the non-arm's length expenditure provisions are not intended to apply to services that are provided by a trustee in their capacity as a trustee. It is the capacity in which these activities are performed that becomes critical here to these gnarly provisions. So there's some more information there on that. So factors to look at that indicate if an individual is performing your activities in their individual capacity and not in their capacity as a trustee or a director of a corporate trustee include: the individual charges the super fund for performing these services. However, the individual can still be acting in their individual capacity if they do not charge the fund for performing the services. The individual uses equipment and other assets of their business or used in their profession or employment. The individual performs these activities pursuant to a license and or a qualification relating to their business or their profession or employment. And the activity is covered by an insurance policy relating to their business or their profession or employment, for example, indemnity insurance. So let's have a little look at the other ATO example that they had for this. So Sharon is a trustee and the sole member of her self-managed super fund. She's a licensed real estate agent and she runs a real estate business which includes property management services for rental properties. Her super fund holds residential property, which it leases on commercial terms. Sharon then provides property management services to the fund as a licensed agent. She's using the equipment and assets of her business to undertake these activities. So she's using the software and her staff. Her actions are covered by her applicable insurance policies in respect of the business. Accordingly, Sharon is providing property management services in her individual capacity of the self-managed super fund with respect to the residential property. She is charging her fund 50% of the price that she would normally charge a client or a non-related party. So for the purposes of subsection 295-550-1, the scheme involves the fund obtaining the services from Sharon and deriving the rental income. For the price that she's charging, it constitutes a non-arm's length dealing. So this results in the expenditure being incurred by the fund as being less than it would otherwise be expected to pay if it was dealing on an arm's length basis. So as such, there is sufficient nexus between the non-arm's length expenditure and the rental income derived from the property, which means that the gnarly provisions apply for each income year the arrangement remains in place. So the rental income is now going to be taxed at the top marginal rate instead of 15%. going to be interesting during this transitional period, and require that if you are doing something like this in your self-managed super fund, to talk to your advisor to make sure that what you're doing is not going to breach these provisions. All right, just a reminder that we have the following SMSF trustee resources on our website. So there's a detailed SMSF foundation course and a guide to establishing a self-managed super fund. There's some key compliance resources which relate to thinking about a self-managed super fund. If you want to set up a self-managed super fund, how to deal with contributions and rollovers. There's some investment education. We get some more information on paying benefits, administering and reporting, and also estate planning. There's also an archive of important news articles and updates on topical SMSF issues, including legislation changes and the annual federal budget information. And finally, there's some information on upcoming live events that are presented by the Self-Managed Super Fund Association that you may wish to attend. So we hope that you find these resources valuable, and they can be accessed at www.vincents.com.au/superannuation-advisory-resources. And feel free to contact us to discuss any questions that you may have in relation to the information provided on our website and how it may impact your specific circumstances. So that concludes today's quarterly superannuation tax update. Vincent's Superannuation Advisory is here to work with you and to make sure that your SMSF structure is fit for purpose to achieve your desired outcomes. So we can help you with your SMSF, your structuring and strategy advice to help ensure that your investments are held in the most tax effective way, and when held in super, that they comply with all of the relevant super legislation and regulations, because it's always a little bit different holding these things in super because of the concessional tax environment. We also offer retirement and estate planning, including facilitating the preparation of death benefit nominations and trust deed updates. We'll work with you and your lawyer and your advisors to ensure that your superannuation estate matters are set up to achieve your desired goals and to go to your nominated beneficiaries. We also offer a range of consultation services to both SMSF trustees, accountants and lawyers, whether it be assistance with highly technical compliance matters, assisting with super and divorce settlements, or acting as court-appointed expert witnesses. If you have any questions, that's a little blurb too on the rest of our services. It's not just super that we offer at Vincent's. If you have any questions, please do not hesitate to contact me on the details that were listed in one of the opening slides, and a copy of the presentation slides are available upon request. Thanks guys, have a great Wednesday.